when I was in adults,
Isn't that funny? You would think the government that represents the public in the
Am I going to trust you? Not turn the other way with taxpayers or intelligence sources? Or am I going to trust you to build the product out? I paid you as cash. There's some people that you trust more than others.
And I literally like last
Yeah, I thought you did.
I can do it. I'm gonna. Literally, Fred told me
One of the three people were working, the other two were cleaning the foldings and the other one was like this.
You gotta know what you're getting into. There's sometimes where
about drafting.
Yeah, well, I've heard a lot of stuff
FanDuel and DraftKings
gets to an end that you
out of
oh, it's for the first time.
Which I use well. I think you just get
Towards like the last,
what they did is
Think about
you're not allowed to bet on DraftKings. So
they bet on it.
FanDuel won like $300,000.
not just feels like, you know, I know it's really bad guy. But I also do
Janet Yellen is getting involved.
it's not like
yeah, my goal is to
so for me, I'm not good on the actual just five.
and so
Yeah.
what lands I built in those risk safeguards, you're saying, okay,
And even then, he's
So I want to go to
It's because we're not damn.
I give them things like information, this is potentially going to the potentially getting this to the bad guy. As long as I understand that, I was able to.
listen, when the bets get involved,
So I don't know, man. I think of people who
now everything is.
But they made enough money if they showed back.
It's one of the most amazing cities in America, and it's built on sport. People who are posturing, that's right, people who are posturing, I mean,
where you have
you know, compare Miami to
all I know is the middle, right in front of it, there's like this
and yet, you look at the building, wait, how'd you get that? They're pretty dang close. There was
it's not a lot. I'm working with the CRA director to get
sometimes
The schedule is such a
that was
Oh, yeah.
and they had to like open up my schedule so that I could sign up for
it works for the city of Las Vegas. I mean,
and then as I said to
because I bring my own milk.
while we're going through that, I'm gonna go together for the rest. So it's like
okay, all right.
because we gotta find out who the plants are gonna be. Are they gonna check out the plants? When do you guys gonna decide your hopefully general or let's see who's gonna charge for transportation and coming from wherever they're coming from.
Never caught a flash.
Go ahead.
Yeah.
It's tougher to graduate class. A lot of people do it now. If you really want to get value, if you really want to get a lot of feedback.
That's pretty cheap.
But I was gonna say, don't feel bad about
I've taught this class with,
every class that I've heard.
I've taught it before.
There's always one person
That doesn't work.
that always.
Right, that's easy, because, but there's no interaction.
No, I mean,
And just feel like you can get 20 people.
I disagree because I mean, if you get a text and send it to
If
you,
you get,
problematic as far as
taxes, property taxes,
yeah.
it's called TIF
I think for a graduate course, so no problem.
Everyone have their opinion of real estate.
I'm able to look at it with,
That's quantitative.
Yeah, I'm not even talking about
There's
you.
another argument.
the best student typically is sending stuff.
That's the difference.
This year,
We don't have to take land use.
Hey, I'm fine. Did you see the
Online classes?
Without having to see all the writing.
But why is there?
But
But why is there? This whole point is why is there?
what I'm looking for is, I want to make sure you guys are working.
I would say I have.
No, but why? But why? But why is
Wait,
there?
something to do
This is
tomorrow?
for
Yeah, that's why
investment,
it's
right?
smart.
Yeah,
Why does the government
Turn around,
charge? Because people would not normally invest in that asset class if they wouldn't do it, right? And so the point is that what makes you money is getting taxed. So the reality is there's an opportunity cost, right? I would normally do timber stuff, right? But the government says, hey, do this, so we're gonna do a tax on that, which limits that money gap.
But Word has a tool, I don't know how to use it really well. But Word has
Even with incentives, why is there incentives? It's not gonna make you as much money. There's no way in the world the government would give you an incentive to make more money than, market rate stuff that.
It's indirect though, you create
Oh, I
jobs,
just did the
so
same
that's the
thing.
incentive.
You want to get to that question, you can ask about that.
That's why the section one.
Mortgage backed securities is a subset of asset based.
Waiting till next year.
But it's usually in that area, right? Government doesn't go into places for incentives unless there is essentially either the asset wise or the government, or they want to build, something and can't create it.
Okay, hey, listen, you guys can keep eating? You guys can keep eating? I just want to get this done while you guys are eating. So, has everybody put their name down?
Somewhat.
Somewhat. Okay, I'm gonna go one by one, and if I approve, no, I'll hit you. I'm sorry, you haven't done it. Surprise, surprise, see? Oh, you put it? Do you like it? I think that's gonna be a good one. I have no idea, that's one of the articles, I pulled it down this week, I haven't read it. That one, okay. Okay, all right, okay, I'm gonna go one by one, guys. I'm gonna go one by one. Hey, it's hard for, I had this problem, the reason I gotta use these things is I lost my voice a couple of years ago with coaching. And so I strengthened my voice, and I'm sort of yelling all week, and when I come out here, I don't want to lose my voice. So I'm just going to sort of look you in the eye, and the U.S. office market. Oh. And you don't want to do the lead thing.
You want me to do the?
No, I'm asking you. You want to do the office market? Okay, got it. Done. Multifamily. Okay. Sorry? Well, no. You got to read the article and see what the article is about. So this is not a guys. This is not a term paper on what you think the subject is. You got to read the article. And your paper flows from the thoughts that are disclosed in the article. So it's not, I'm going to write about Santa Claus, okay? There's a reason why these articles have been assigned. Now, multifamily, I have 3 people. I got Victor, I got Steve, and I got Christian. come back to that. Brandon, you're good with retailing?
Yep.
Irene, you've got hotel? Frederick? Timberland? You're good? You're from Jacksonville? Rainiers headquartered there?
No, I do deals internationally, like Wood in Indonesia, Africa.
Oh, perfect.
Yeah, so
Excellent.
now dealing with the Timberland, I can do that sector, Wood, or.
You gotta read the article,
Okay.
and then you extend from the article, but no. Listen, I am not interested in the article I'm not interested in a term paper or an assignment that deals with, for example, the sale of commodities such as wood. I'm interested in the real estate market of timberlands. Now, timberlands may be grown for building products or flooring material or consumer goods, but there are underlying economics to timberlands.
Gotcha.
Okay?
Okay. Just read the article.
Read the article and you got it. I like that. Emmanuel, you're going to do. It's two different articles because there's an old one called, and then there's a newer one called "Is Farm the Next Bubble?" So it might be an interesting way to contrast. Maybe the answer is it is, and maybe it isn't. Okay? Janae,
Yes.
are you going to praise?
No.
Okay, all right. So you want to do appraised value? Okay, we'll take that.
That's what I wanted to do today.
Gotta be good.
Yeah. She bumped me out the way, man.
No, I used to cheat on my naps in kindergarten, and now I feel so bad. Never being able to fall asleep in kindergarten.
Stone crabs last night, 13 pounds of stone crabs in a case of like a secret guy, like my neighbor, like secret guy. Oh, dude, you look at these things. No, these things are massive. Like I used to go stone crabs and stuff. No, this guy brought them up to my neighbor across the street. Yeah, those are big. They're big. No, they're big, man. They're great. I used to my ex-girlfriend's dad has like 30 crabs off campus. We used to go stone crabbing. And the size is not the same, but the quantity, like 200 small, what's it called? Claws. Trying to catch it. 2 weeks we go out and do it. Where's Frederick when you live?
They pop the little pops in
Oh, it's awesome.
the
Yeah,
box, you have on the plane, you go, and
What's that sign called where he grabs the straps and he tells us they're different than someone else's straps? It's like a huge deal.
Can we ask you, where's the
The answer is yes, you can ask her that. Okay, Kate. Okay, listen, let me ask a couple questions. This is generally okay. Kyle, your math is good?
Yeah, I think so.
Okay.
I
Hold on, let me see.
Please look at
Mine's like a nice paper.
I don't think so. I think
Mine's
you're.
like a nice paper, right? I could like.
Hopefully everyone's is not. Yes.
I don't have to put in a lot of diagrams like that.
Probably not.
You don't have to put a lot of work
I'll
in.
put some diagrams.
Don't do too much
I
work.
like writing papers.
I just,
Okay,
So when you have the diagrams and there's so
my
much.
shit.
I don't know, I forgot which one I picked. I didn't have a choice.
Laura,
Four.
you good with Excel?
No.
People were yelling at me. To move.
Would you consider like the workings of private mortgage bankers or the origins of securitization. Those are not gonna be mathematically driven. So the problem is, the origins, okay, so I'll put you here. Okay, I'll put you here. Which is gonna be the last one, okay? And Kathleen,
No, not that strong, so.
why don't I move you to the workings of private mortgage bankers?
Oh, wow.
Tyler, why don't I give you, I have to really bust on you in
I
this
like
program.
You haven't bust on me because I always had other people taking the hit. Dylan was here, I had him for a while. Dustin was here.
Dude, Dusty took a lot of the hits.
Not the confidence.
Is my topic already?
Yeah, I wish you would have taken a more challenging one, but yeah.
Oh, I was actually, I was taking because I was interested in it.
Okay, then that's fine, that's fine. Okay, how, you did economics, undergrad. How good is your Excel? It's good. You don't want to tackle leverage in a private equity portfolio?
What date is that for?
It's for the 21st. It's not the next one, it's the one after.
No, I want to. Oh, that was one of
You
the
see that face? Sing with confidence.
Yeah.
Good thing this isn't as persuasive as it.
Maybe you could put more topics in the topics.
It's not topics, it's articles. It's articles. So the answer is yes, I could chat.
I got a question. Was there one on government regulation? I didn't.
No, I didn't find one.
Okay.
Listen, unfortunately, you see like at the end, there's a lot of these articles have to do with REITs. The problem with doing research, academic research, is you need sources of information. And it's very time consuming to get information. But REITs, for example, publish a lot of information, so a lot of people find doing research on those things. So, you know, and ultimately you're trying to draw conclusions or relationships that may exist.
You could buy one share and get a perspective.
But you don't even need to, at this point, you could pretty much get it, you know, in most places, yeah, without,
No, because my last class I had to drag out for a month. And then I come in every other weekend for 4 hours and finish up the program. Instead of just doing it 4 sessions and just being out.
Noah,
Yes.
would you take an article on, an article called Leverage and Returns in Cross-Country Analysis of Public Real Estate Markets?
Sure. I actually liked the one I chose, but I'll do that.
I think the problem is, I probably need to give that one, I've gotta give,
That's fine. I was just thinking of flipping paper.
That makes a lot of sense.
this one, the rating agency was probably more a factual one, and sort of regulatory, just explaining. It probably is.
So,
Yeah. Why don't I move you to leverage and returns
where is that?
on the 21st?
Actually,
It's called leverage and returns, a cross-country analysis of public real estate
so
market.
there's a black mark.
And maybe that's one of the ones I just added. I added, well, when I got more people, I had to go back and pull out like 3 or 4 more articles.
So leverage and returns.
A cross-country analysis of public real estate markets. Thank you. Diana, can I give you the role of rating agencies? Again, we've got rating agencies. It's actually more interesting than the name sounds, believe it or not.
Well, I went for a lot.
The last one. So, okay, so the only conflict I got left is Victor and Christian.
Professor, so we read a lot about
Last
No, they're changing it. Before, when we took it last time, or even this summer,
Yeah, for like that one I did.
and then we had 7 hours.
Oh, this not works only during the summer.
No, they've been changing how it works. It's just like due diligence and finance are still like this, but you can take finance and West Palm Beach on Tuesday at 6 to 10 p.m. if you want to do that, but they're changing it around.
Okay, listen, Christian and Victor, you two are the only ones that I still have to divide. You both cannot do multifamily. The only other article I have is called leverage in a private equity real estate portfolio, and I need somebody who can work Excel on that one. Now, I got no other way to split the multifamily one other than to flip a coin.
Wait, so what day is that other one?
Is on the 21st.
And what does
The
that have
third.
to do with?
Leverage in a private real estate portfolio is probably the most important article that we have here.
And actually, I thought you might pick that, Ivan.
That's the one with Excel?
On that one.
You don't need to use Excel, but if you use Excel, it really, you know, it can really help the class. You'll take that one? Okay, so you're gonna stay with multifamily?
Who's taking that?
Christian. Okay, listen, I'm gonna repeat. Next session. Hey, next session. Maricela, the U.S. office market. Victor, the market for multifamily. Brandon, real estate and retailing. Irene, determinants of hotel prices. Frederick, Timberland real estate investments. Emmanuel, agricultural real estate. Janae, appraised value versus sales price. This third session, Christian, leverage in a private equity real estate portfolio. Noah, leverage and returns, a cross-country analysis of public real estate markets. Carol, why real estate? Modern portfolio theory applied to real estate. Kyle, the role of real estate in institutional investors' portfolio revisited. Paul, hold versus sell decisions. Tula, inflation illusion. Quincy, I'm warning you, that's a tough article. Okay, I'm warning you. But it's an interesting one. Okay, it's an interesting one. The origins of securitization. Laura Lopez. The role of rating agencies. Diana. The workings of private mortgage brokers. Kathleen. Wait a minute, you're in 2 different ones. Oh, you already had securitization. You already had that. You had your name in 2 places. Oh, I didn't realize that. Okay, then listen.
I'll take the role of rating.
So then that means I can.
You can go back to rating agencies if you want, okay? Why don't we do it that way? So, you're going to stay in securitization and mortgage act. You're going to go to rating agencies.
I can think outside of the article, correct?
Yes, you can think outside, not I'm not looking for dissertations here. I'm looking, listen, there's material in that I either cover in my lecture or a student covers. So to the extent that you cover, they hear it from somebody else. So if you drift too far, then I got to go back and cover what the article had. Okay? So the answer is, you have to build on what's there. Determinants of, doctor, determinants of mortgage interest rates.
What date, sir?
The last one, the 5th.
Okay.
Steve, lead, rent premiums, operating expenses and lead rent premiums. Rebecca, genetics, home ownership, and home location choice. Tyler, does focus really matter? Alex, performance difference in property types. Chad, the impact of property diversifications on REIT liquidity. Yeah?
Can you tell me what we got?
The last one, the 5th of December.
So the first group is on the 7th, right?
That's correct. I'll leave this up here in case there's any questions before the end of the class, okay?
No, that's the first round.
William bought it.
Now, what I might do, hey, listen, if you can't get the article in the journal, I'll email the article to you. If you can get it in the journal, here at the library, I'll just tell you, listen, go to the Nova Library, it's in so-and-so journal. You know what, I'll probably just email them all, it doesn't matter, it's easy.
Thank you.
So when's the second group?
The 21st.
21st, right?
I always bring all kinds of current
Are you
events.
gonna email us the list, like the finalized list, what to look like? So I can remember.
Just told you.
Yeah, but.
December 5th.
What if I say yes and don't do it?
And I'll email you tomorrow and say, can you send me?
What was the,
That's
who was the, I'm not good at quoting biblical things, but who was like who was the wise one? The one who said he was going to do something and didn't do it, or the one who said he wasn't going to do it and did it?
And they said neither.
Okay.
Who was the good son? They said neither.
You want me to send you an email now?
Bible, where one son said he was.
I'm just saying since your computer's open.
On Instagram.
Yes, he would.
Do you want me to send you a Snapchat?
Yeah, no,
Who's a better son? The answer is neither.
Are you like making fun of millennials?
No, I'm not, but wait, yeah, the answer is I will eventually. But, no, can you close your computers if we're working now in class, please? So one of the things that we, one of the things that I'd like to do is, one of the things I'd like to do,
He doesn't want you on the computer.
Oh,
Just making sure she's in the class.
yeah.
she's not in the class, I already told you that. One of the things I like to do is bring current events to class. I won't, there's so much, and we just look, and things that sometimes, a couple of things. We had a guy about 3 years ago came in. She's fixing her Snapchat.
I'm like fixing
Okay, we had a guy from an institutional investor called GLL Partners came and spoke 2 different years and gave presentations to our students, and they're really phenomenal to hear a guy who manages very long-term institutional core money talk about what they look for in acquisitions and, you know, and all that. And every year he would bring a bunch of questions that he would give to the students to ask. And I just, from one of those sheets, I pulled out these 3 things that are comments that I don't think we talk about anywhere else in the textbook. Maybe we do, but I wanted to mention them. One, when we talk about institutional capital, we talk about commingled funds versus separate account. Does that ring a bell? Commingled funds? What's the difference? So we all know, because we'll talk about that. What's a separate account?
One where you're not commingling the funds.
No shit.
That's a good response.
Individual account. I can't.
There's an earmark purpose.
And so, listen, so asset managers, and we'll define asset managers later, but asset managers generally work for a fee. So since they've got a machinery involved with acquisitions people, disposition people, asset management people, financial people, the more funds they can capture, the better. Typically, it's easier, I would say it's easier to raise a commingled fund. You reach out to a bunch of people and you get people to diversify the risk. It's not all their money in a particular portfolio, right? So you can, you know, one of the things when we talk about why real estate, when we talk about leverage in real estate, right? One of the things that leverage, for example, allows us to do is to diversify, right? And the bigger pool of money that you have, the easier it is to diversify. So if I can raise $3 billion, I can provide my clients a greater diversity level, geographic, asset class, than I can if I have a $200 million fund. And so from an institutional perspective, I'd say commingled funds tend to create a larger pool and provide more security, theory, and more diversity to clients. Now, certain clients have specific targets for investments, and so what they'll do is they'll sit with an asset manager and create the box. And they'll say, I want specific exposure to this. I want retail in Florida. I want hospitality in the Caribbean. I want suburban office in Sunbelt markets. I want industrial in port cities. I want CBD office in 24-hour cities. You know, I want an asset that doesn't, you know, have a value of more than this. I don't want leverage more than that. So you create the box that the asset manager works under. Okay. Obviously, you have more discretion in that sense. You're putting the asset manager into a bigger box, into a smaller box, but it also reduces the diversification of a particular investment. Okay. Did you want to add anything to that? Does that kind of? I meant to know discretionary versus non-discretionary. Don't answer that, no. Discretionary versus non-discretionary. And that is in the context, discretionary obviously is that the asset manager or the fund manager functions purely at his will, within the guidelines that are established in the agreement that he has with his client. So he makes acquisition and disposition, he or she make acquisition or disposition decisions on their own accord, following the overall guidelines and parameters that were established with the investors. Non-discretionary means that the, say, acquisitions guy need to propose to the client the acquisition, and that the client can veto it or approve it. So it's whether the asset manager ultimately, it's like a broker. Does he buy for you or does he execute orders for you? Okay? I think those are the only two terms I wanted to bring from there. From today's newspaper, there's a guy named William Ackman. Does anybody know who this guy is? Pershing Street Capital. Have you seen this guy? This guy says he has had a horrible week. There's a guy that got into a yelling fight with Carl Icahn on CNBC Squawk Box one day. You guys, you never saw it? It's like, so you guys know who Carl Icahn is or no? So he's an old crusty guy, like from Queens. And this guy's like one of these like sort of like $1,500 suit guys, you know, impeccable, you know, impeccably dressed, his hair. And so he manages like, I forget how many billions, he's got like $20 billion under, it's called Pershing Street Capital. And lately he's not been doing really well. He took a very long position in a company called Herbalife.
And then the other one went against him.
And Carl Icahn went against it. So they got into this, like during an interview, got into it, and this guy's going, he's a little kid in school that everybody used to beat up on, and then he would run to his parents, you know. It was a really hilarious, you know, thing on national TV. But anyway, that still hasn't unwound, and he's still, I think, underwater now. But this week, he bought big into a company called Valiant, and Valiant is a company that's aggregated a series of pharmaceutical brands underneath it. It's a company out of Canada, and they've been doing a bunch of acquisitions. And so, I was going to say Allergen, it wasn't Allergen, but they bought one of these large biotech firms about 8-9 months ago. And they did it with significant equity from Ackman. And he now owns like 20% of Valiant. And what happened is a short seller by the name of it's like Citron or something like that. Forget the guy's name, whatever. This guy came out yesterday and said, listen, these guys they've got phony accounting. They're generating fake sales through a variable interest entity. Does anybody remember that from the accounting class? So they've created a variable interest entity. They're selling stuff to it. They don't consolidate it. They're not really sales. And all of a sudden the value of Valiant's gone down. It's gone 40% in 1 week. In 1 week, which is this guy owns 20% of that company, so you figure, you know, it's billions of dollars. So he lost $2.5 billion in a week.
It's cash flow.
So when you're managing $20 billion, now these guys use a lot of leverage, you know. So, but I mean, he's like, so, and then apparently he had another company and went down. So there's a lot of money to be made in the markets, but there's a lot of money to lose. And then we'll talk about all this stuff. You can be long, or you can be short. And if you're long, what does that mean? Don't tell me that you're not short. If you're long, that means you are expecting prices to go up. And if you're short,
then
it's
there's
not a
no
stature
extra
thing.
money you can lose because
Well, you
it can continue to go up.
That's if
As long as you have asset back.
you can be. You're talking about specific positions where you can be naked short, but you can also hedge a short. So you don't have to have unlimited loss. But the general, without getting into specific trading, the general understanding of being short is, or implication is, that you're expecting prices to go down. We'll go into this in more detail. Long, you're expecting prices to go up, you're optimistic, you're positive, you're buoyant. You're short, you're bearish, you're negative, you're pessimistic, you're expecting prices to go down.
Sorry,
Yes?
question.
Yes, ma'am.
Using that same case you just gave us, suppose as a fund manager, I bought a large amount of shares, and somewhere in there, I was speculating and derivatives are involved. And this situation happened, complex derivative, and this happened by this plunge. Just elaborate for me now how the derivative work out in the market. What happens with my derivative position?
Okay, I'm not going to answer that right now because we need to define derivatives before we talk about what happens. So we'll talk about derivatives, I think, third class, okay? So derivatives are financial instruments that derive their value from an underlying or another asset, okay? So we'll talk about that because that's more than just a, sort of brief, observation now. If that's okay. Is that okay?
That's fine.
Okay. I'll leave this one for a second. All right. Worldwide real estate asset growth is spectacular. So from an institutional perspective, people are estimating that Marisela, I need your front. Can you, please?
Yeah.
It's very difficult for me to see backs. From an institutional perspective, it's estimated that assets grew in value 20% in the last year. And what that further says is that this is a pool of 93 asset managers who manage $1.2 trillion worth of assets. Now this is worldwide, not US, which is what I quoted before. So worldwide. What I thought was interesting here is that real estate represents $387 billion out of 1.2 trillion. So roughly 32% of their holdings on an institutional perspective are dedicated to real estate. So now start thinking, now you're starting to think, who are the big players in real estate? Well, definitely real estate is held by pension funds, life insurance companies, wealthy families, sovereign wealth funds, etc. And their values continue to increase. Now, the question that I would ask myself is, if real estate went up 20% last year, what should I expect it to go up this year? I don't have an answer for that, but for a long time, when we had this bubble where all these prices were going up, and I'll use residential real estate values were going up, what, 30% a year? Is that sustainable? Does disposable income go up 30% a year? Does people's ability to service mortgages go up 30% a year? What are historical returns? What are 100-year returns for residential real estate in the United States? Does 6% sound like something? So they're historically 6%, and they go up 30 and 30, and we have something called mean reversion. What's going to happen at some point?
Decline.
Either you're going to be totally flat for a very long time, or at some point you're going to have a decline, right? Other interesting thing, assets by property class. So this is from the top 50 managers that were surveyed. Again, where do they put their money? What asset classes do they put their money on? Single largest holding, surprisingly, office, 35%. Second one, multifamily, 22%. It's kind of interesting because from, again, my intuitive expectation, multifamily would have a lower return expectation and be a safer haven than office. And hence would have a higher allocation. But if the higher allocation is going to office, it means they're looking for what? Greater returns. People are looking for returns. All these institutions, why do they manage money? Why do pensions manage money? So that when people retire, you pay them out. When people die, when life insurance comes in, when people die, you have money available, right? And so all these companies are promising certain proceeds at a certain point, and they've got to generate the funds to get there, right? They use actuaries for all this, but at the end of the day, they got to put money to work, and there's a certain return expectation. But then, from what we just saw with office, probably more risk. So depending on what happens with their mortalities, with their redemptions, with retirements, they may not be able to meet things, okay? Retail is 17%, industrial is 2%. Interesting here, timber, 3%. So most individuals can't get exposure to timber, but institutions do. Hotel, 2%. People don't like hotels. Farmland, 2%. And then other, 6%. So, assets by location. If you look in the U.S., the West, we'll talk about that another day. We'll talk about that another day. House Republicans under pressure to move the debt limit bill this week. So, let's talk about, bless you. Yes, Danny.
Quick question. I was reviewing recently their allocation, pension funds allocation, the top 20, and it caught my attention that their allocation to REITs is minimum versus their allocation to private equity, at least in real estate. Is there?
Well, I think, what I'll show you is that there's a, and I don't want to blow a punchline, but there's a different risk and return profile to publicly owned real estate versus to private equity. And, the fact that you're a pension fund and you already sort of fit the characteristics of the holding period, the no need for liquidity, etc., you would opt to own real estate privately as opposed to seek that liquidity. At a certain point, you know, and I didn't want to minimize the point Carol was making, institutional real estate in this country is very liquid. If you have a Class A asset in a major metro, you can probably sell an asset today in less than 60 days. I mean, that relatively, you know, it may not be liquid for me if I need to buy dinner tonight, but if you're an institution managing billions of dollars and you know, you need to raise a couple $100 million bucks, you can sell a part of a portfolio in 60 days in this country. It's relatively liquid. You don't need the liquidity that the public markets give you. And again, I think REITs behave differently than privately owned real estate, and we'll go through all of that later on. So I'll answer that in another class. I think Paul was the one who answered it. The national debt, federal government debt, because it doesnn't include state or municipal governments or other quasi-governmental entities, is at $18 trillion. And so the sort of carrot and stick that the people in Congress have is we will not approve an extension of debt until we get our spending under control. So I'm not going to spend a lot of time. This is one of my pet peeves. I've blown up on it. I did like a 30-page presentation one day. I've shown it in some classes. But for the younger people, I'd be scared. I'd be scared because for every living American, there's almost $60,000 worth of debt, plus the interest that accrues on it every year, and there's no amortization of that. And like I tell people, I won't be around to repay it, so you got to pay too. You know, and that's the problem is we spent the future generations' wealth, and I don't know where the assets are. We've just spent it, so we've opted to live opulently. It's the European story, talking about the collapse of of the empire. It's the European story. You get used to living in a certain lifestyle, and then you expect the government to provide certain things, and there aren't the resources to do it. I want to be in France. I want to work 30 hours a week. I want to be paid when I have children. I want to have a pension that's greater than what my salary was. I want to have all my medical care paid for, and I don't want to pay taxes.
You just printed it, you can spend it.
Well, and that's sort of indirectly, indirectly because we've had the Fed buying the Treasury's debt, so we haven't printed it, but we've gone about as third world that way as we can to do it. Doctor.
Yeah, my question was based on that comment and the debt ceiling issue. I'm wondering if it is truly a rational reason why the Congress is taking that position, or is it political?
Likely, I would say it's political. I think one of the sad things that I've seen over my adulthood is that I always tell people when I was young, I recall politicians acted based on perceived policies, not party lines. One of the things that always marked the difference in this country from Europe was that we didn't vote along party lines. I remember being young and seeing there were very conservative Southern Democrats that would align themselves with conservative Republicans, and very liberal, Northeast Republicans that aligned themselves with Democrats. So people voted for ideology, not parties. Now you can't violate party lines. So if your party says this, that's what you adhere to. And it's created gridlock, and it's created absurdity, and it's, who can promise more, and who can sound, better than the other guy. I think there's an argument that says at a certain point you need a carrot and a stick. So yes, I'll raise the debt limit, but you've got to give me a solution on what you can't continue to spend more than what you bring in. So give me the plan. So I think there's some underlying, but this is like the fourth or fifth time in the last 3 years where we get on this. And all we're doing is we just keep kicking the can down the road. Just kick it down the road, kick it down the road, kick it down the road. So here's, I should have read this one. So the New York Stock Exchange, so the actual exchange itself is pleading for rules to make hedge funds reveal short positions. So we'll talk a little bit more about trades and all that in another class, but what are hedge funds?
Exactly the opposite of what they sound like. How about that one?
What do they sound like?
Huh?
What is a hedge fund?
It sounds like you're hedging against your losses. But in
sounds.
reality...
What's a hedge?
precious metals over here, currency over here. When one goes up, the other goes down. There's an equilibrium. So you've hedged your losses.
Okay, so said in a different way, a hedge is a financial transaction in which you take one position to mitigate the risk in another.
That's
Is
what
that what you were saying?
Yeah.
That's exactly what you were saying, right? Okay, but a hedge fund is not that.
No.
Okay, but what is a hedge fund? I didn't tell you what it wasn't.
So it's where you take a position of volatility to make the returns, high returns, because they get paid. It's 20 and 1.7, typically, right?
Okay,
So
let's back up. By the way, this may be a question that you get later on this semester.
You're
just so that you know.
entering offshore or non-domestic market to get returns to
No,
offset.
so a hedge fund is a hedge fund. We're going to talk about it later, but I'll mention now. A hedge fund is an unregulated pool of funds. Okay, so it's a company that essentially operates without any registration. It operates under the Registered Company Act, or sorry, the Private Company Act of No. It operates under. I want to say the right thing. I don't want to say the wrong thing. You know, it's a tremendous amount of information, and it is, isn't it?
Yeah. Page 85. Page 85.
I don't know what it actually said.
Registered Investment Act, 1940. I believe it's the Registered Investment Company Act, the Investment Company Act of 1940, okay? But essentially, they are unregulated pools of money that are only available to qualified investors. And they operate with a total lack of transparency. Part of their operational mode is that they work in total secret. So, for example, a private equity firm like Pershing Street Capital, like this William Ackman guy that I just mentioned, will once a quarter publicly disclose their holdings. They will publicly disclose what positions they have that are long, which positions they have that are short, what they've bought, what they've sold. Hedge funds don't disclose anything. And people vilify hedge funds, right? So this guy that shorted Valiant is a hedge fund. He came out and he said, hey, I did some research and this guy has phony accounting. Now, he didn't disclose this, but he's got a huge short position on this. So when he mentions this and the stock goes down, he makes a ton of money. Right? So the New York Stock Exchange as an exchange, which is where these companies trade on the secondary market, where they trade their securities, is looking for regulation of these hedge funds. Because there's a perceived damage that is being caused by this lack of transparency. Now, we'll talk more about hedge funds when we get to equity, because hedge funds are not necessarily bad. Hedge funds provide a tremendous amount of liquidity and assume risks that many traditional investors would not undertake, because they have a higher return expectation. They're willing to assume risks that those with less return expectations would not.
So essentially, they're making the secondary market more volatile or more liquid because they're spending.
Well, no, they are creating markets. They may play in secondary markets, but they also create markets. For example, I'm not saying it was good or bad, but all the high-rise condos that were built in South Florida in 2005, 2006, 2007 were financed with mezzanine debt from hedge funds. Banks didn't want to finance it. They didn't want to assume the risk. They started financing it, and the regulators cracked down on the banks because they couldn't provide unsecured debt. But hedge funds were willing to step in and provide that liquidity, for example.
So they use high-risk baskets to invest the bond.
Well, you could say high risk. hedge funds have different profiles as well. Some hedge funds are very sort of macro driven, you know, they're expecting, you know, the economy to go up, and they just use huge amounts of leverage. And just the fact that they want a 3% increase in stock prices, but they're leveraging 8 to 1 or 20 to 1, they're going to maximize their returns. There are some that are, you know, company specific, that, you know, will take negative, you know, short or long positions. So there's a lot of different strategies. I'm not a hedge fund specialist. We'll talk a little bit more about that, okay? Matt, Chad.
It's you know, the lack of transparency. You're talking about vilified. Donald Trump has come out and, you know, on the campaign trail said that he's going to tax the crap out of hedge funds, and we all know Donald Trump has significant amounts of money, you know, dedicated towards hedge funds.
Yeah,
So
but
it's
yeah, I
like-
mean, you can't, whatever a politician says publicly, you know.
Right, but I mean, again, it just goes back to they are the villain of the stock market, you know. That
So
they're,
hedge funds are bad.
No, not necessarily, you know.
They're market makers.
Well, no, they're not. Market makers are something different. They provide liquidity to markets, which is different. They provide liquidity at times that other people are not willing to provide the liquidity in marketplaces, okay? But the point is they drive, and you saw one guy's position all of a sudden dropped the stock of a company 40%, impacting one particular guy to the tune of $2.5 billion in 1 week. We talked about, Daniel was asking about why people would, why institutions would invest in private equity as opposed to in REITs. So from Wall Street, there was an article this week that says a private equity firm called Harrison Street Capital in Chicago is taking a student housing REIT called Cap Mkts private. So taking it private means what? It means it buys all of the outstanding shares that are being publicly traded, that are in the secondary market, and essentially eliminates that from the, you know, public domain. Why would they do that? Why would they do that? I think I cut another one out. There was another one. Why would they do that? So this is another.
Better yield.
Ultimately, it talks to valuation, and it talks to, does the public market provide a higher return, or does the private, you know, realm provide a higher return for a particular investment? In general, this is very broad, right? In general, general statements are generally wrong, okay? But in general, publicly traded instruments or publicly traded companies have a higher valuation than privately held companies. Why? Typically because of liquidity. If for nothing else, liquidity. Case in point, I want to give you my rule of thumb, right? So my rule of thumb. Middle market, you know, M&A activity. You see a company buying a privately traded company, they're going to pay 4-5 times EBITDA. That translates to like a 16 multiple. 6 is a 16 multiple, 16 times earnings. 6 times, you know, so what's the reciprocal of 6? 16%, right? So the implication, if you're trading a company that's privately held at a 16 multiple, what's the S&P trading at today? Should have read the Wall Street Journal this morning. 22 and change. So just again, in general, which is historically high, okay? But just where I'm going is private valuations tend to be lower than public valuations. So in general, most of the time, you will get a higher value for a company that is owned in a public venue. But if people are taking companies private, it means that there's a perception that they're not being valued that way. Here's an article, and this is talking about the buying spree that's happening in the real estate arena. There was a REIT that was recently taken over called New York. It was some sort of residential REIT in New York. It wasn't a long-lived one. But it says, the buying spree is largely driven by the mismatch between REIT shares and the underlying value of the properties. REITs traded at an average discount of 13% as of October 1st, according to Green Street Advisors. I don't know, Green Street is a market research firm that is based in Texas and just tracks the real estate industry, just tracks REITs. They do very exhaustive research. I tried to get free research from them. I can't get it, but you try. And it says it neared almost 20% in August, so it's actually come down a little bit. But their perspective is that the underlying value of the assets in a REIT is 13% higher than what the market share of that REIT implies. So why are people going private? Because there's value creation there. You buy it at less and it's worth more. Make sense? Something to think about. I talked about this earlier. Forest City is a REOC, a real estate operating company. They're transforming themselves to a REIT. They're a developer. They're the guys that build those shops at Gulfstream Plaza or whatever. But they've operated, they own real estate, they hold it. It's obviously not in the most tax-advantaged vehicle, and so they're converting to a REIT. Now, there's implications. I'm not going to spend time on that in this class, unless you want me to, but there are implications to being a REIT. The single biggest one, how it relates to this class is a REIT has to distribute 90%, a minimum of 90% of its net income to shareholders every year in cash. In cash. What are the implications of that? If you're distributing 90% of your net income, what does that mean to a company?
You have 10% that could be liquid.
That could be liquid? Okay.
Can we use?
Right, so I mean, let's go back. Most of you guys probably took like accounting or capital markets or something like that, or like financial markets or something in undergrad. So a company has an earnings per share, right? And that earnings per share kind of gets distributed.
It could be high.
Well, it could be high, it could be low, it could be negative, okay? But that earnings per share can even be subdivided into a couple of different, and we can talk about payout, or we can talk about retention, right? Right? And so the payout is the dividend that it pays, right?
Very low retained income.
Well, so most companies in the S&P, and I'm going to give you sort of San Miguel off the top, mathematical thing, but most sort of mature companies, so we're talking about like industrials that have huge cash flow, are probably only paying out, their payout ratio is less than 50%. So for every dollar they make, they'll pay half of that to their shareholders. They retain the rest. Why do companies retain? Why do companies have retained earnings? Why do companies retain money? To finance future growth, to have a sort of like a built-in reserve in the event of bad times, right? Presumably the real answer from a financial perspective is because they are going to generate a higher return for that shareholder in the future than by paying it out. So they're telling the shareholder, what I'm retaining, I'm going to multiply for you. Otherwise, the shareholder would say what?
Does Apple still not pay dividends?
Apple's been paying dividends for at least 3 or 4 years now. They pay, it's not a high yielding stock, but it yields 2 and change, I think. And so, but the implication of a high payout, a high dividend payout, is that you don't have capital to grow. How do REITs grow? How do REITs grow? Buying buildings. Buying buildings. What does it take to buy buildings? Capital. What happens if you distribute your capital? You can't buy buildings. So REITs are one of the few industries that are actually sort of permitted, and I say permitted, now, I mean everybody can do it, but it's sort of allowed in the investment community to do secondary offerings of stock. Most companies do not do secondary offerings of stocks. Why not? Why not? What? So
it's expensive.
Well, but if I can raise $100 million and it costs me 3, I'll take it. I'll take the 97. Why would a company not issue additional shares? Why would a company not issue additional shares?
dilute the value of the outstanding.
Because of the dilution factor. Because if right now, the 25 of us in this room own a company, we each own, what, 4%, right, of the company, right?
Yeah.
Let's bring in another 25 guys. How much do we own?
2%.
Who wants that? Nobody wants that, right? And so you know, sort of the conundrum that REITs are under is that they distribute the money, but then they gotta raise capital. So they do it, you know, to the extent that they can use debt, they do. To the extent that they use preferred shares, which don't dilute the underlying shareholder, they do. But they are very active in the capital markets, raising funds in order to fund growth. This is an interesting one. I'll just mention it for the folks from New York here. Blackstone leads a deal to buy Stuyvesant Town Housing Complex. Now, this has been in the news forever. This was MetLife built this back after the war. It's like 10,000 residences. Some of it are in rent-controlled, you know, districts, okay, or some of it is rent-controlled. And those are sort of like rent control goes back to like socialist days in this country, back in the 20s and 30s and all that. But so obviously, if you buy something and you can't raise the rent, you know, it's an implication on value, right? Met sold this to I don't want to read it. God, I'm getting old.
Did you say Blackstone or BlackRock?
To Tishman, no, Blackstone. So MetLife developed it, held it from the 40s all the way up into like 2005. They sold it to Tishman, and it was highly levered. And the lender was Lehman Brothers. So, you know, Tishman walked away. Lehman, which was already in bankruptcy, wound up with this thing. It's taken like 7 years to finally get to the point where they could sell it. Well, somewhere along the way, Fortress bought it. So one of the guys that bought our company, Fortress, bought the distressed debt, and they've now sold it to Blackstone. Now, Blackstone is a private equity group. They're the largest of the private equity groups out there. They are now publicly traded. But these guys have been expert at buying huge chunks of, you know, they bought Hilton right before, you know, blew up. They bought Equity Office International before the market blew up in 2008. But they were able to buy it. These were $20+ billion transactions, and essentially flip some of the assets underneath and get their money back, and then still hold on to assets. They've just been masters. The fact that they've got such capital concentration, they can come in and buy something essentially at a lower price per pound than somebody could buy the pieces. Then they carve it out and hold on and make a nice return. But anyway, so they bought this thing, and what I thought was interesting is they recently they just recently raised a $16 billion fund for real estate. They've invested a chunk of that with Wells Fargo buying the real estate arm of GE Capital. So they're buying this thing for $5 billion. It's 11,000 units. So the average price per door is $473,000 per door. So yeah, I don't know what rents are in New York. It's talking about some of these rents would be like $3,000 to $4,000 a month, but still, it sounds like a very low cap rate. So
the rent controls expired?
On some of the stuff they promised, the city's provided some of the financing on this, and they've apparently guaranteed the city a certain exclusion on a number of units through, I think, like 2035. But that's all math, right? They take Excel and you do your math and see what you can't grow and see what you can grow and see what you can finance, and you come up with your return. It's all money. It's not. There's nothing else. There's no emotion in this. It's all yield.
They're bundling their rent packages and tranches now, and they're actually selling them off on paper. Blackstone. And they're the ones that have innovation homes down here, and hence the 2013 nobody could buy a home because every house was purchased cash because they appropriated like $6 billion to South Florida.
Okay, I know there were a couple of private equity funds that got really big into buying homes, and I think Blackstone is one of them.
Build them all the time.
What I don't know is what you're telling me that they are
So
essentially securitizing the rent on the
Correct.
homes.
tranches of paper, which is the rent of the home.
Okay, if you can bring me some information on that, I'd love to read it.
Yeah, it's pretty crazy.
I'd love to read it, because that doesn't, so I just don't know how you securitize a rent, okay?
They're
No, don't pull it on your phone now, don't, that's homework for you. That's homework. I'll hold you to it. Yes, Carol?
Yes, on the REITs, we said they pay out, but they're paying out dividend, right?
Yes, ma'am.
So they're retaining their capital, right?
Only 10%?
Only 10%.
Oh,
They pay out 90%
of the capital, of the earnings, right?
of the net income.
Of the net income.
Not of EBITDA, of net income.
Right, so capital is still there intact. It's their return, they're paying out 90%
Of their net income.
of the net income, so the capital is still there untouched.
Well, I understand, but how do you grow?
Yeah, how do you?
Okay, so
How
that's
do you-
right, okay.
How do you grow? And say you're an office REIT, forget, well, so I don't wanna, okay, we'll take the accounting class. Tyler, I wanna ask you this question. Can you please tell me what capital expenditures are associated with office development or ownership?
I don't remember. Don't kill me.
Dude, I'm not trying to kill you, I just want to make sure. The problem is you cannot graduate if you don't answer this question.
Is that a homework assignment?
There will not be a diploma. Your employer has told me they will not reimburse you for this program.
Is that how it is?
Yeah. All real estate has the following, in addition to acquisitions, real estate has significant capital expenditures associated with it, which are fronted. Office in particular is affected, but you've got leasing commissions, tenant improvements, okay? Concessions, okay? And no, not pass-throughs. This is what they got up front. And capital improvements that they need to make on a building to just keep it at its operating level, which are not pass-through. So not maintenance expenses, but capital improvements, you know? You want to keep a Class A office building going, you know, you got to replace the mechanical systems every X number of years. You got to replace the lobby, you know, marble and things like that. So TI, leasing commissions, which are huge, are paid. Leasing commissions are paid when? Leasing commissions are paid when?
Up front.
They're paid in concept
Ongoing.
up front, and they are paid 50% at lease signing, 50% on occupancy. Well, I should say on lease inception, not occupancy, lease inception. You can negotiate that, but you typically can't negotiate that, okay? I'm not going to go into this. What is the bond market telling us about real estate prices? I'm not going to say anything to that, other than that there is a historical, it's homework, that there is a historical spread between bonds and real estate returns. And what this whole article, and it's in Bloomberg, was talking about is, well, so bond prices, BBB rated bond prices have jumped in return 120 basis points over the last 6 weeks. So the implicated people are saying, oh, well, what does that mean to real estate prices, right? So there's a lot of different moving pieces here, right? It's like a black box and you know what comes out, but you know, number one is BBB rated debt has a higher yield. That means real estate must have a higher yield. If you have a higher yield and net income doesn't change, what does that mean to value? If cap rate goes up and net income doesn't change, what happens to value? It goes down. There's an inverse relationship between cap rates and value. So if bond prices go down so that yields go up, what this article is trying to say, and the implication is if interest rates go up, property values are going to go down. Now, it's not that simple, because if interest rates go up, there's going to be inflation. If there's inflation, you can increase rents, and that's ultimately going to translate to net income, net operating income, okay? But there's cycles here, okay? You guys find this interesting, or is this like, no?
Yeah.
It's very interesting.
But
It's real life.
Well, you start. Are you from the school that interest rates are due for, it should be increased?
Oh, I've lost a lot of money on that in the last few years. I don't bet on that one anymore.
It's overdue.
Are you thinking it's
no.
overdue?
So, listen. We're gonna talk about debt and we'll talk about interest from a theoretical perspective in the next session. None of us have the answer to that. None of us have the answer to that. I will say this to you, okay? The Fed does not determine interest rates in this country. That I know. Unfortunately, a lot of people follow what the Fed does, and markets react to what they think the Fed said or is going to do or not do. The baseline interest rate in this country is not the discount rate offered by the Fed. We'll go through that next week. So the Fed, in and of itself, does not set interest rates in this country. The market sets interest rates in this country. This is a market economy. Okay, there's a lot of different theories on how interest rates are set, and we'll talk about that. But ultimately, the Fed is a big player in the debt markets. Okay, it can influence, but in and of itself, it doesn't set interest rates. It behooves no one today in the world for interest rates to go up. Okay, so governments are going to work their butts off to keep interest rates low. If the national debt is $18 trillion, on the short end of the yield curve, the government is not paying any interest, essentially. So on T-bills, it doesn't pay anything, essentially. And on 10-year treasuries, it's paying 2%. And on 30-year treasuries, it's paying 3.3%. It's paying nothing. If interest rates go up 200 basis points, what does that mean to the $18 trillion we've got to service in debt every year?
More interest.
It's going to like triple. It's a significant increase. So this government has no interest in it. No other government that's in the same boat, because all the industrialized countries in the world are in the same boat. Nobody has a vested interest in interest rates going up. There are a lot of other industries, including the real estate industry, that don't have a vested interest in interest rates going up. And so, do I think that in a true free market environment, in equilibrium, given the deficit spending that governments have, that interest rates shouldn't be higher? Yeah, of course they should be higher. Of course they should be higher in a normalized setting. But the real issue here is stop the think. I don't want to jump, right? What is, you guys are going to have to know this for a test, so I might as well tell you. Fisher's Law. Fisher's Law says, I didn't prepare for any of this stuff. It says that the nominal interest rate is the real interest rate plus inflation, right? The nominal interest rate, so the face rate you're going to get, so said simply, right? It's actually a more complex formula than this. Right? You don't have to write it down. We're going to go into this next week. But just absorb, think. Hear me out. So what it basically says is if the stated interest rate is 6% and inflation is 3%, that the real rate of interest is? No, if the stated rate is 6% and inflation is 3%, the real rate of interest is? 3%. Okay, because said the other way, right? Said the other way, nominal less inflation equals real. Equals real, right? It's algebra. Yeah, I know that's right. 3 plus 3 is 6, okay? Now, I'm giving you some numbers, but I'm not just pulling that out of the air. So, what's historical inflation in this country? 3. How do you know? Did you go to Fred? Did you go to Fred and pull this out? I mean, you can know. You don't have to guess. You can know. You should know. You're in real estate. You got a tenant that's coming to you right now and wants no bumps on their rental rate. What is it? You're going to tell them 1.6? What if inflation is historically 3%? Why would you give them 1.6?
Because that's what it was this year.
Yeah, but that's this year. What about mean reversion? So would it surprise you that inflation in the long term in this country is approximately 2.5%? Sounds about right. Would it surprise you that most lease contracts in this country ultimately wind up getting negotiated to increases of either CPI or what, because people don't like this blank, they'll just go anywhere between 2 and 3%. And why would landlords agree to it? Because they've got a certain level of certainty or security that inflation is going to be more or less 2 to 3% every year. We'll talk about baskets and indexing and all that, because that you know, it's not that simple. But inflation has historically been about 3% in this country, and historically in this country, interest rates for a long time, and interest rates are about 6%. And curiously, I wish I'd kept this. The closest people have gotten to empirical studies on what is the real rate of return, what is the real rate of cost of money. There's got to be one. There's got to be one, right? What, in the absence of all the other friction that we have of inflation and liquidity preferences and all that, there's got to be a real interest rate. If I'm going to loan you money, what should I expect to get from it? Independent of all those other factors. And curiously, it kind of drops back to about a 3% number. People kind of work backwards toward that. You know, you can kind of work back because you know what the nominal rate was and you know what inflation was, so you kind of work back to what a real rate of return is, right? So it's about 3%, okay? So why did I tell you? I didn't lose track of that. Because if, for instance, treasuries are 2%, but inflation is 3%, yeah. The reason interest rates are low is because people don't want to assume the risk because of what happened in 2008 to go to other investment choices. So they're willing to lose money for security. And that's why we don't have real interest rates. Because people don't believe that they can realistically assume the risk for the returns that they're getting. Or people are afraid. And I don't want to get into the psychology of investing, right? And I'll talk about, ultimately, we're not risk averse. As people, we are generally not risk averse. We are loss averse. And there's a big difference between that, right? Because I can draw mathematically for you different options. I won't do it in another class, right? But what really concerns us is losing money. What did I tell you about my personal situation? What I can't afford to do is lose money. I'm loss averse. I know that. I am loss averse. Yeah, take risks. Yeah, I'll drive fast, I won't jump out of an airplane, but no, but what you don't want to do is lose. We don't want to lose. And that's affecting people's investment choices, and that's affecting where capital is being driven, and that's why interest rates are low. That's my humble opinion, okay? And until people believe that they can invest without that risk of loss, people are going to continue to buy. Why would you buy a bond that yields, 2%? Even if it's risk-free. It doesn't excite anybody. 2%? For that, I might as well just put it under the mattress. Somebody had a question. Chad.
So you're talking about the bond rates and, the book. You kind of mentioned in that article that with bond rates going up and potentially the interest rates, that may have a sign for the real estate market. But the book was like saying that the interest rates are separate from the bond, and in fact, they could very well impact the bond market. They're not, while they have a relationship, they're not the same. And so I guess I didn't understand why then were people betting on interest rates going up with the bond market increases, or like what?
Okay, well, we'll talk about debt and interest rates next week.
Okay.
And I don't know how you derived where you're at, because bond prices and interest rates are inextricably tied.
Correct.
And they function in an adverse relationship.
Right.
But bond prices are totally driven by market interest rates. Okay, so.
But that's what I didn't understand. You were saying that with the bond prices going up, you're saying there should have been a relationship with real estate, and then you started talking about the interest rates going up, and I was like, wait a minute.
Okay, so what that article was saying is that BBB yields have gone up 120 basis points, and there's a relationship of, I forget, they were saying like 250 basis point spread between BBB treasuries and cap rates.
So they're not expecting interest rates to go
Well, no, these have jumped up 120 basis points in the last 6 weeks. So what the author of the article is saying is hey, we should expect cap rates to go up 100 basis points as well. If cap rates go up, what happens to Valley? Go down. In this 6-week period, as these yields have gone up, what has happened to the bond prices? They've gone down. We'll go through that math. That's the only math we do in this class, is calculate the price of a bond. Okay? And how interest rate changes impact. Okay? Just 2 quick ones. Hedge funds are bringing back everyone's least favorite toxic investment, collateralized debt obligations. We'll talk about securitizations on the last one. These guys have issued $250 million. It tells you right here, $250 million deal. But this stuff is not toxic, okay? So they've pieced together bonds from certain banks, community banks, and then they've sold it. So single A rated bonds typically yield 2.5%. These collateralized debt obligations are yielding 6%. You think there's any risk there? Probably, right? Last one. A lot of times things happen in the world and we don't think about it. Someone asked me earlier what an asset-backed security was. So most of you know what a commercial or residential mortgage-backed security is. It's a pass-through instrument. We'll talk about these in more details. Pass-through instrument in which the cash flow for the investor is provided by a series of underlying obligations. In a real estate space, it's mortgages, but in other spaces it could be credit cards, it could be student loans, it could be car loans. So it was a recent scandal with Volkswagen where they had the software that was tricking the emission standards, and they got caught. And really, when you stop and think about it, it's not just in the U.S., it's all over the world, because VW really sells a very small percentage of their sales here. But it's a huge, ultimately it's a huge breach. People get pissed at companies. Why do people get pissed at companies? Because stuff like this, right? Are people good or bad? Somebody in a company made this decision. A lot of people in this company knew about this. A lot of people in this company knew that there was an investigation about this for quite some time. And yet all of a sudden, one day it comes out, the stock of the company goes down 40%. By the way, Volkswagen is 40% owned by the state of Lower Saxony, so it's even like a quasi-governmental, entity. But I didn't even think about it. But so, as a lot of other industrial firms, they have a consumer finance business, and they finance the vehicles that their dealers sell. And what do they do with those notes? They securitize them and sell them to other investors. Great. So what they're basically saying is that there are $3 billion worth of securitized notes, or $3 billion worth of car loans that have been securitized and sold to third-party investors. Now, if I owned a Volkswagen, right, and I got pissed, because I don't want to deal with this company, just stop paying on the loan. Here's your car, dude. This is not what you sold me. What you sold me is not what I bought. There's $3 billion worth of defaults waiting, right there. Has nothing to do with any other risk other than, corporate, misgivings, right? But, I never even thought about it. I just thought, okay, they're going to get fined or whatever. But there's implications to all this stuff. Stuff happens.
So they get fined a lot because they sold $3 billion of securities?
No. They're going to get fined for having violated clean air standards.
But what happens with those $3 billion?
Well, I mean, I'm going to tell you, you're going to be at risk to some extent because you don't know what's going to happen. In this country, you haven't heard it, but I can tell you because I watch the news from Spain every night. People are pissed. I mean, people are pissed, and you can get, like probably in Austria or some of these like really green places or whatever, like people are going to take your car back. I don't want your car. I bought it because it was clean technology. Now you're telling me it's not clean technology. We don't want it. Who's going to,
Yeah.
And what's the underlying collateral worth, Yeah. Now the car, so I'm not saying there's going to be a default, but now there's an incident that you don't think had any financial implications, and it does. 2 last words of wisdom. All great deeds and all great thoughts have a ridiculous beginning. All great deeds and all great thoughts have a... That's from Albert Camus, who was a writer and a philosopher, right?
Also, they go unpunished, right?
Sorry, punishment?
No great deed. No great deed.
No good deed goes unpunished. Okay, hey, let me tell you this one. There's a guy, he's one of these like modern day gurus that sells all these like, it's got a guy named Anthony Robbins. I don't watch any of that. These little things come out in these smart grease that I get every day. And it was so basic, but it's what I tell people all the time. Action is the key fundamental to all success. So, you want something? Get off your butt and do it, you know? That's all you got to do. It's a great country. My old boss had a boat, well, still has a boat, and his boat is called What a Country. And it really is. You know, you can do anything you want to do, or be. You just got to do it, you know? So you guys want to be developers? You know, you want to be high financiers? You want to run, you know, big firm? You can do it. It's a matter of, you know, going out there. What's the name of the boat? What a Country?
No, I'm saying you name boats, you put the name on the boat on the side of the back. Why can't we do that for like cars and stuff? It's like,
You can.
These are the kind of things that go through my head.
Listen, you can start. Listen, sounds like a business to me.
One regulator raised the issue that you just now get tax concessions based on it being the clean air and all that, and the fact it's fraudulent. Now they're thinking they should have the right to reconsider and they should be refunded.
I don't know the conditions under which some of those tax concessions are made, but I would suspect that they would probably be, you know, revoked. So, you know, ultimately, anytime you have a government subsidy or support, it generally is tied to performance or behavior, right? So to the extent that you don't conform to it, I would suspect that there's some ramification that isn't going to be positive to the company. So. You could probably buy the Volkswagen paper like cheap now.
Yeah, that's what I was just.
Probably. I'm sorry. Question? What is your car? Are you cold? You're like, I'm cold. That's why I put my jacket on.
Off their paper, once they went through bankruptcy, they made a fortune out of that.
I want to cover. The day is still young. Listen, I know for a fact that you all must leave here tired. That you must leave tired. I know it because when I drive home, like I never do anything Saturday night when I teach. I mean, I want to get home and like just, I'd have a beer, and fall asleep on the couch. So I know. We read 5 chapters this week, hopefully. Very basic. They kind of went over different topics. I'm not going to go through whatever. You know, textbook gives you these like what the learning objectives were and these rubrics. But I'm just going to sort of go through it. You know, talked about asset class, talked about financial markets, talked about financial instruments. You went on to chapter 2 and it talked about financial markets, the role of institutions, the role of government.
So have you tried to solve or go over the problems at the end of the chapter?
What I suggested is if you have specific questions on a question that was asked, you can bring it to the class. I'm not going to go through all those questions.
No.
Oh, should you, you're saying? Depends how much you want to learn. So let's be pragmatic, right? One of the things I always tell people is, you know, like when we were kids, a lot of times we got bad grades, and we got bad grades because we couldn't figure out what our teachers would expect from us in a test or in a class, right? As we get older, we'll hopefully mature that. So, and I'm not trying to be funny with this. If the question is, do you need to do the answers to that in order to satisfy you know, the objectives, or you're gonna be asked in the exam? Probably not as much. But there may be some chapters that you have specific interest on. And I say that because someone else asked a similar question, you know. I don't care about bonds personally. So like, if I were to read the book as a student, I just want to blow through it, learn the basics,